Welcome back to Trading Hour. Let's now shift focus to the commodity space. Manisha joins us, and today Manisha is focusing on crude oil. Manisha, over to you.
Well, the crude oil prices have put in a second monthly decline for the month of August. We saw 1.5% of decline on Friday, and for the month of August, it's down between 3 to 4% for both crude varieties. September hasn't started on a very positive note either. One, it is about OPEC and allies. At least 8 countries within that community are going to be increasing production, phasing out those voluntary output cuts from the month of October itself. While, of course, there is an OPEC and allies meeting for the month of September, further guidance would come in from that. But at this point in time, the industry believes that 180,000 barrels per day of an increase in production is what you could be looking at from the month of October, and there would be gradual increases phased out in the next 1 year. The second important point is about the China manufacturing activity that has shrunk to the lowest in 6 months for the month of August. So the Chinese demand continues to be a concern. Third is about the consumer spending. The data that we saw come in from US, that number is on the positive side. That tells you that perhaps the rate cut that we are anticipating in mid-September will not be 50 basis points, but there is a 70% probability of it being 25 basis points. So because of this uncertainty, and now because we're looking at a lower rate cut, is something that yet again has led to some profit taking coming into the markets. So from 82 to nearly 78, 79 is how we've seen the crude oil prices to decline as well. Of course, the Libya production cuts is one thing that the street is waiting for, and the other thing is the US crude inventories, which also are at a 2-year lows right now. But the street does believe that 80 to 82 on the higher side right now is a stiff resistance, and the markets perhaps could be trading within that 77 to 82 for the month of September as well.
Thank you very much for that, and the much anticipated